Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 2, Corporate Formations and Capital Structure from Pearson's Federal Taxation 2024, Corporations, Partnerships, Estates, and Trusts. The learning objectives from this chapter includes discuss the tax advantages and disadvantages of alternative business forms, apply the check the box regulations to partnerships, corporations, and trusts, recognize the legal requirements and tax considerations related to forming a corporation, discuss the requirements for deferring gain or loss upon incorporation, explain the tax implications of alternative capital structures, determine the tax consequences of worthless stock or debt obligations, identify tax planning opportunities in corporate formations, comply with procedural rules for corporate formations. So when starting a business, entrepreneurs, they have to make a decision. They have to decide whether they want to organize the business as a sole proprietorship, a partnership, a corporation, a limited liability company, or a limited liability partnership. So as we go through this chapter is going to discuss some of the advantages and some of the disadvantages of each form of business association. Because as we know, much like with anything in life, there's pros and there are cons. So when it comes to entrepreneurs, sometimes they find organizing their business as a corporation as advantageous, but in this chapter, we also look at all of the different organizational forms, and we take the time to examine some of the tax implications of deciding to set up a corporation and what are some of the other advantages and disadvantages of the various forms. So when an individual starts a business, they can organize it in several forms. And this includes the easiest, which is a sole proprietorship. There's no paperwork that's necessary. You can just wake up one morning and decide that you want to start a business. So you have a sole proprietorship. Let's just say it's you and another individual or other persons that want to start a business. You can start a partnership. And much like a sole proprietorship, there's no legal documentation that needs to be filed. However, since it's more than one person, you would definitely want to make sure that there's some verbiage in black and white determining how all of the operations of the business are going to be handled. Next, we have a corporation. And with the corporation, we essentially need to file paperwork with the state. Corporations fall into two categories. We have C corporations and we have S corporations. Both have limited liability, and we'll explain some of the advantages and disadvantages of both. And then we have LLCs and we have LLP. So LLC stands for a limited liability company. It's a hybrid. It combines the best features of a partnership with those of a corporation. And then we have a limited liability partnership. And this is the business form that's attractive to owners of professional service organizations, such as accounting firms, doctors. The reason why they choose this is because they want to limit their legal liability. So under state laws, LLPs, the partners are only liable for their own acts and omissions. They're not also liable for the omissions of the under individuals. So as it relates to a sole proprietorship, as mentioned, a sole proprietorship is an unincorporated business that's owned by one individual. It's often selected by entrepreneurs who are, starting out a business venture and they have a modest amount of capital and they're not really exposed to too much liability. So from a tax and a legal perspective, a sole proprietor is not considered a separate entity. Essentially, as a sole proprietor owner, you are an extension of the owner, or the business rather is an extension of the owner. So in such case, the individual owns all of the business assets and the individual reports income or loss from the sole proprietorship directly on his or her individual tax return. So specifically, there's a form called Schedule C, and Schedule C is profit or loss from a business, or they can use Schedule CEZ of Form 1040. So some of the advantages of a sole proprietorship is that they're not subjected to a second layer of tax. They can easily withdraw cash without any consideration of how dividends are treated. They have lower individual marginal rates compared to corporate tax rates. And it ultimately depends on the individual taxpayer, because due to the Tax Cuts and Jobs Act, corporations are subjected to a flat 21% tax rate. So depending on the individual's taxable income situation, their marginal tax rate can be as high as 37%. So this third bullet point might be an advantage or it might be a disadvantage. Again, it's dependent on the individual. Any business losses can offset the owner's other non-passive income. So this is definitely one of the benefits. And this is also one of the areas where, unfortunately, sometimes persons, they make up businesses. It's fraud, if you want to, be honest. But this is what sometimes people start a business and they legitimately do have a loss. So they are eligible to claim that loss. In addition, there's a qualified business income deduction in light of the flat 21% that corporations are subjected to on their taxable income. Individuals are allowed to claim the QBI deduction, which allows an exclusion of 20% of the net income. Some of the disadvantages of a sole proprietorship is that the profits are taxed even if they are not withdrawn. So unfortunately, a lot of times this happens. An individual, they start a business, let's just say they have $10,000 worth of net profit, and they just keep it in the business. Unfortunately, even if they didn't take out the $10,000, they are subjected to taxes on that income. So that's one of the disadvantages. Certain fringe benefits may be taxable to the owner. They must use a calendar tax year, so it must be from January 1st to December 31st. And sometimes the highest individual marginal rates, as I mentioned earlier, might be higher than the corporate rates. There's 7 tax brackets for an individual, and it goes as high as 37%. So based on the individual's income, 37% versus 21%, that's a big difference, 16%, right? So it's a big difference. Next, we have partnerships. So much like a sole proprietorship, a partnership is an unincorporated business that's carried on by 2 or more individuals, entities for profit. So the partnership form is often used by friends or relatives who engage in a business and by groups of investors who want to share profits, losses, and expenses of an investment, maybe such as a real estate project. So a partnership is a tax reporting entity, but a partnership is not a tax-paying entity. So the partnership acts as a conduit for their owners. Partnerships are essentially considered flow-through, aka pass-through entities. So the income, expenses, losses, credits, and other tax-related items, they pass through to the partners, and these partners report these items on their separate tax returns. So each year, a partnership has to file a tax return, and they file Form 1065, which is the U.S. Partnership Return of Income. And they basically report the results of its operations, whether there's a net income or a net loss. And when the partnership return is filed, the preparer must send each partner a statement. And this is Schedule K1, Form 1065. And it essentially reports the partner's allocable share of partnership income, expenses, losses, credits, and any other tax-related items. And then when the partner files their personal tax return, based on the form they receive, they're required to report these items on his or her separate tax return. Right? So that's important to keep in mind. So similar to a sole proprietorship, the partner's allocable share of business profits is added to the partner's other income and taxed at that partner's marginal tax rate. Here we have an example of just, forming a partnership. Partner A decides to invest property. They receive 50% partnership interest. Partner B contributes money, and they also receive a 50% partnership interest. So general versus a limited partnership is important to, look at some distinctions between the two. So for general partnerships, the general partner has unlimited liability for partnership debts. Therefore, their liability can be greater than any capital that was invested. So that's for general partnerships. There has to be at least one general partner. One person bears all of the risk, and the others can choose to be limited partners. Next, we have a limited partnership. So under a limited partnership, LPs, the limited partners, they are liable only up to the capital that they've invested, plus any agreed upon amounts. And in a limited partnership, we must have at least one general partner and one limited partner. So here we see some advantages and disadvantages of partnerships. So we'll start off with the advantages. With a partnership, there's no entity level taxes. As mentioned, there's no double taxation. The partnership files an informational return. The partnership does not pay any taxes. However, the income, the losses, the deductions, and the credits, the gains and the losses, they essentially pass through to the respective partners, and they report it on their personal tax return. So a partner's marginal rate may be less than the corporate rate. We know the corporate rate is 21%. The corporation's distributions or the contributions/distributions are usually considered non-taxable. Any non-passive losses can be offset by any income on a partner's Form 1040. Much like a sole proprietorship, partners are allowed to take advantage of the qualified business income deduction. Next, we look at some of the disadvantages. Much like with a sole proprietorship, the profits are currently taxed whether or not they're withdrawn. The partner's marginal rate could be more than the corporate rate of 21%. So again, the partner's marginal rate could be as high as 37%. There's no tax-free fringe benefits since you cannot be an employee of a partnership. And much like a sole proprietorship, a partnership must use a calendar year tax year. So it must be from January 1st to December 31st. Next, we see here the corporate structure. And as mentioned, corporations fall into two categories. We have C corporations and we have S corporations, and both have limited liability. So C or S corporation, there's shareholder A, B, or C, or there might just be one shareholder. So some advantages of a corporation, and is that there might be a possible lower marginal rates on an entity basis. The shareholder employees can have tax-free fringe benefits. So if you have a corporation, you can be an employee of a corporation. A corporation can use the fiscal tax year. And the top corporate marginal rate, as mentioned, thanks to the Tax Cuts and Jobs Act, is 21%. Corporate tax rates used to be progressive like individual tax rates. However, at the moment, assuming Tax Cuts and Jobs Act remains even past 2025, then the corporate marginal rate will remain at 21%. Next, we have some disadvantages of C corporations. One of the biggest disadvantage is that C corporations are subjected to double taxation. So the C corporation is a tax-paying entity, much like individuals. So therefore, when the corporation has taxable income, let's just say it's $10,000 of taxable income, the corporation would pay a flat 21%, which is $2,100 at the corporation's level. And then let's say that the corporation distributed $3,000 to one of the shareholders. The shareholders will include the $3,000 of income on their personal tax return, and then they would have to pay taxes on that $3,000 at the shareholder level. So that's one of the limitations, the biggest disadvantages of a C corporation. There's double taxation when the corporation distributes the earnings as dividends to shareholders, and essentially the shareholder has to report it as income. In addition, the shareholder may have a taxable dividend upon the distribution of property. So it's not like a partnership or a sole proprietorship. Shareholders can't just withdraw money or property from the corporation without recognizing income. So anytime there's a distribution of cash or property to a shareholder, It's generally taxable as a dividend if the corporation has sufficient earnings and profits. Next, net operating losses and capital losses stay at the entity level. They don't pass through to the shareholder. So if the business has a capital loss and it's formed as a C corporation, unfortunately, the shareholder does not get to take advantage of that loss. It just stays at the entity level. And C corporations are not allowed to take the 20% qualified business income deduction. Next, we have S corporations. So an S corporation is designated because it's governed by subchapter S of the Internal Revenue Code. But like the general corporate tax rules, they essentially apply to an S corporation. So much like a partnership, S corporations are considered a pass-through, aka a flow-through entity. So some of the advantages of S corporation is that the S corporation is not subjected to tax at an entity level. There's no double taxation. Instead, they also file an informational return, much like a partnership. A partnership files Form 1065, and an S corporation files Form 1120S. And then from there, the shareholders receive a Form K1, and they report their allocable share of partnership income, expenses, losses, gains, credits, deductions, etc. The shareholder may have a lower marginal rate than a C corporation. Non-passive losses can offset any income on the shareholder's Form 1040. The income and deductions retain their character. So we just mentioned with a C corporation, if the C corporation has a capital loss or a net operating loss, it stays at the entity level. But with an S corporation, if an S corporation has a capital loss, then it is allocated to the shareholders based on their respective ownership, and they are allowed to claim it on their personal tax return. And lastly, the QBI deduction allows exclusion, so S corporations are allowed to claim the QBI deduction. Some disadvantages of S corporations: shareholders are taxed on all profits, even if it's undistributed. The shareholders' marginal rate could be more than the 21 flat percent that a C corporation is subjected to. There's no non-taxable fringe benefits for a shareholder owner. They must generally use the calendar year accounting period. There's a limited number of shareholders. For an S corporation, there can be a maximum of 100 shareholders, and they may have additional compliance requirements versus just being a sole proprietor. So there's some advantages and disadvantages for a limited liability partnership and an LLC. As we discussed a little earlier, with an LLC, it combines features of a partnership with a corporation, but from a legal perspective, obviously it's neither. But with an LLC, owners have limited liability features of a corporation. And in the event that an LLC has more than one owner, then they're treated as a partnership for tax purposes. And as we mentioned with the LLPs, this is basically attractive to owners of professional service organizations. So when they have an LLP, the partner is limited with respect to the other partner's acts in such case. So here it comes to check the box regulations. So most unincorporated businesses, they can make the decision, they can elect to be taxed as a partnership or a corporation under rules that's commonly referred to as check the box regulations, right? So it's available to unincorporated business, and they can choose to be treated as a partnership or a corporation. So if there's 2 or more owners, then the default is a partnership unless they make an election to be treated as a corporation. If it's 1 owner, then it defaults to a disregarded entity, and they're treated as a sole proprietorship, which files Form Schedule C, unless they make an election to be treated as a corporation. And they can make the decision to be treated as either a C corporation or an S corporation. All right. So as it relates to forming a C corporation, and as we continue on with this chapter with corporate formations and capital structure, we're going to focus in on C corporations. So in order to allow taxpayers to incorporate without incurring a high tax cost and to help prevent taxpayers from recognizing losses and maintaining an equity claim to those assets, Congress essentially enacted what's called Section 351. So Section 351A provides that transferors, they recognize no gain or loss when they transfer property to a corporation solely in exchange for the corporation's stock, and if after they immediately have control of the corporation. So just keep that in mind. So simply stated, if the transaction falls under Section 351 and meets the requirements, then there's no recognition of gain or loss. So the requirements are as follows. There must be a transfer of property. 2, it must solely be in exchange for stock. You cannot receive stock and cash or stock and other property that's treated as boot, as we'll explain a little later. So it must only be in exchange for stock. And 3, the transferors must be in control of the corporation immediately after the exchange. So the rationale behind it is that the transferors have not changed their situation economically. So they shouldn't be taxed. They own the property before they formed the corporation, and they still own it afterwards, right? So let's say an individual had a property, the property was worth $50,000 and they exchanged it, they formed a corporation, they transferred the $50,000 property to the corporation. They still have ownership of the property via their ownership of the corporation. So therefore, based on that logic, that is why there's this deferral of gain. So as it relates to Section 351, the shareholder takes a carryover basis from the property to the stock, and then there's an alternative calculation. We start off with the fair market value of the property that was transferred, and we would subtract any deferred gain, or we would add any deferred loss, and this would determine the basis in the new stock. So here we have a quick example. We have shareholder A. Shareholder A contributed $100 in cash, and he received 50% of the stock of new company. So his basis in the stock is $100. And next for B, shareholder B, they contributed land with a fair market value of $100 and an adjusted basis of $20 for 50% stock. So in this case, the cost basis in new company stock is $20. So we see here the fair market value of the transferred property minus any deferred gain plus any deferred loss. So in this example, as we are dealing with shareholder B, the deferred gain is $80,000. So 100,000 minus the basis of 20, which is 80. So therefore, based on a calculation, we start off with the fair market value of the property transferred, which is 100,000, and we subtract the deferred gain, which is 80, and that is why the basis in the stock is $20. For shareholder A, they transferred cash. It was worth $100. It is worth $100. So therefore, there's no deferral of gain to be subtracted or loss to be added. Now here we look at Section 351 as it relates to property that is being transferred. So the rule of gain or loss, non-recognition, applies only to transfers of property to a corporation in exchange for the corporation's stock. So unfortunately, Section 351 doesn't necessarily define the term property. However, the courts and the IRS, they define property to include cash and basically any other asset. So this could be accounts receivable, inventory, equipment, even intangible assets, trademarks, computer software, etc. But a few things are excluded from the statutory definition of property, and this includes services, So if a shareholder contributes legal or accounting services rendered to the corporation in exchange for stock, this is not treated as property. Any indebtedness of the transferee corporation that's not evidenced by security, any interest on transferee corporation debt that accrued on or after the beginning of the transferor's holding period for that debt. So in such case, services are not considered property, but there is a caveat. In the event that a person transfers both services and property to a corporation in exchange for the corporation's stock, all of the stock that's received by the person, including any stock received in exchange for services, it's counted towards the 80% threshold. So whenever this happens and the individual transfers both services and property, then the property must have more than nominal value for that person's stock in order to count, right? So based on the IRS, they have an advanced ruling. And based on the advanced ruling, the stock received for the property must be more than nominal value if it is at least 10% of the value for the stock received for services provided. All right, so we'll go into a bit more of this in detail in another slide. So here we see this example. We have shareholder A. They had a fair market value of a property of 60,000 and the adjusted basis was 15,000. So there's a gain of 45,000. Shareholder A owns 60%. And here for shareholder B contributed services worth 40%. So the control requirement is 80%. So because the control requirement was not met between shareholders A and B, shareholder A has to recognize the entire $45,000 gain. So therefore, that is why when setting up a corporation, it is definitely important to do some tax planning to ensure that the shareholders understand the complications and potential tax implications of forming the corporation. So for Section 351, as it relates to the control requirement, it is governed by Section 368C, and the definition of control is as follows. 80% of the total combined voting power of all classes of voting stock and 80% of the total number of shares of all other classes of stock. This also includes non-voting preferred stock. So they must meet the 80% threshold for each class of stock, not just the non-voting preferred as a whole. So here we have this example. We have shareholder A. They have property with a fair market value of 80,000 and the adjusted basis is 15,000. And then we have shareholder B. Shareholder B received 20% of the new company stock. The fair market value of the services are 20,000. So therefore, shareholder A owns 80% of the property. So therefore, we have this 80,000 minus $15, so 15,000. So there's a $65,000 deferred gain. So the 80% control requirement is met. So therefore, shareholder A does not have to recognize the $65,000 built-in gain. So here we see what the basis, as mentioned, the basis is always the fair market value of the transferred property minus deferred gain plus any deferred loss. So in this case, the fair market value of the property was 80 and the deferred gain was 65. So we subtract that. So therefore, the basis to new company stock for shareholder A is 15,000. This brings us to a next example. We have shareholder A. And shareholder A contributes property with a $70,000 fair market value. The adjusted basis is 15,000. So there is a gain of $55,000. And shareholder B contributes services worth $30,000 for 30% of the stock. So because shareholder B only contributed services, 30% does not count. So therefore, 70% does not meet the control requirement. Therefore, shareholder A has to recognize the $55,000 built-in gain on the property. So as mentioned, there's a caveat when an individual transfers both services and property to the corporation in exchange for the corporation's stock. So here we see in this case, shareholder A contributed the property worth $70,000, and the adjusted basis of the property is $15,000. And then shareholder B contributed fair market value of services worth $25,000 and fair market value of property worth $5,000. So in this case, the 80% control requirement is met. And the reason being is because the fair market value of the property contributed is over 10% of the value of services. So in this case, we see the services contributed were 25%. The shareholder would need to transfer at least 10% of the value. So in such case, 25,000 represents the fair market value of the services multiplied by the nominal value of 2.5. So they would have needed to contribute property of at least 2,500. In this case, shareholder B contributed 5,000. So therefore, the entire 30% ownership applies to this transaction. So therefore, shareholder A does not have to recognize the $55,000 gain. Instead, it is deferred. So here we simply see another example when there is an exchange of both property and services. So the key thing is that the fair market value of the property contributed needs to be at least 10% of the value of the shares received for the services provided. So here we have disproportionate exchanges. So section 351, it doesn't necessarily require that the value of the stock received by the transferor doesn't have to be proportionate to the value of the property transferred. However, in the event that the value of the stock received is not proportionate to the value of the property transferred, the exchange may be treated in accordance with its economic effect. So it might be treated as maybe there is a constructive gift, maybe there's some compensation, maybe there was extinguishment of a liability that was owed by one of the shareholders. So those are some key things to keep in mind in such case. So here it says a dad contributed property worth $75,000 and a son contributed $25,000 worth of cash. However, we see that both of them equally own 50 shares of new company. So based on this, the dad may owe gift taxes on the extra 25 shares that have been transferred to the son. If section 351 is met, then the dad can defer a $45,000 gain. But based on this information, it seems as though the dad made a gift of 25 shares to the son because this is a disproportionate exchange. And since we see this section 351, it is very important, again, to do some tax planning before the individuals come together and decide they want to start a corporation and they want to transfer property because there are tax implications. So if all section 351 requirements are met, the transferors recognize no gain or loss on the exchange of their property or stock in the transferee corporation. The receipt of property other than stock does not necessarily render the entire transaction taxable. However, it could result in the recognition of all or part of the transferor's realized gain. So some of the questions are, is there a realized gain or loss? Is there a recognized gain or loss? What is the character of the recognized gain or loss? What is the carryover basis to the new company's stock? And what is the holding period? So as we go through these questions, we need to determine certain things. So what is boot? So if a transferor ever receives any money or property in addition to stock in the corporation, then the additional money or property is considered to be boot. So boot may include cash, notes, securities, any non-qualified preferred stock or stock in another corporation. So upon receiving boot, the transferor recognizes gain to the extent of the lesser of the transferor's realized gain or the fair market value of the property that was received. So just keep in mind that transferor can never recognize a loss in an exchange qualifying under section 351, whether or not they're receivable. And the character of the recognized gain, it ultimately depends on what type of property was transferred. So for example, if the shareholder transfers a capital asset, such as stock in a corporation, then the recognized gain is capital in nature. If they transfer Section 1231 property, like an equipment or a building, then the recognized gain is ordinary in character to the extent of any depreciation, recapture, and things of that nature. So here we just have some examples of boot, cash, notes, property, securities, stock in another company. Boot is not stock in the transferring corporation. So in order to compute the shareholder's basis, the basis in boot is the transferor's basis. It starts off as equal to the fair market value. So the basis in a new company stock is the adjusted basis of the property transferred to the new company. You would add any gain to recognize. You would minus any fair market value of the boot received. You would minus any cash boot received, and you would minus any liabilities that are assumed by the corporation. And that would determine the adjusted basis of the stock received. So here we have an example of the allocation of the gain. So we have equipment with a fair market value of 30%, an adjusted basis of 20,000. So here we see there's a realized gain of 10K. The fair market value minus the adjusted basis gives us 10K. Next, we see the land. The fair market value of the land is 70,000, and the adjusted basis is 20,000. So therefore, the realized gain is 50,000. So based on this information, we have the allocated boot, and we have the gain recognized. So in such case, we start off with the basis in a new company stock. They received 50,000 plus 50 shares in a new company stock. So because they also received cash, in such case, their basis is impacted as follows. So these are just some additional issues. And now we look at the effect of Section 351 on the transferees. So this is the corporation. What is the impact for the corporation? So is there a realized gain or loss? Is there recognized gain or loss? What is the character of the recognized gain or loss? What is the carryover basis to the assets that have been received? And what is the holding period? So anytime there's a transfer of the company's stock or debt issued by the company in exchange for services, property, or cash, there's no realized or recognized gain. The new company transfer of property to the new shareholder, gain is recognized as if it had been sold. And unfortunately, if there are losses, then the losses cannot be recognized. So therefore, it is encouraged for the individual to sell it first. So as it relates to the corporation's basis, it starts off with the transferor, the shareholder's adjusted basis in the property that's transferred to the corporation, plus any gain that's recognized by the transferor, and we subtract any reduction for lost property. And that determines the new corporation's basis in property received. So here we have an example. It says Bob transfers to new corporation a piece of land with fair market value of 20,000 and an adjusted basis of 2,000 in exchange for 100% of new company stock. Bob has owned the land for 2 years. Since Section 351 applies, then new company will take an adjusted basis in the land of 2,000 and will have the same holding period as Bob. So that's because Section 351 applies. In this next slide, it says Bob transfers to new company a piece of land with a fair market value of 20,000 and adjusted basis of 2,000 in exchange for 50% of new company stock. Bob has owned the land for 2 years. So since Section 351 does not apply, because here we see he exchanged it for 50% of the stock. Since Section 351 does not apply, then Bob recognizes $18,000 in gain. So therefore, NewCo will take an adjusted basis in the land of 20K and will start a brand new holding period because Section 351 requirements were not met. So the effect of section 351 when there's a receipt of lost property. So section 362E2 prevents shareholders from generating double losses by transferring lost property to a corporation. So this is one of those things where Uncle Sam realizes that there can be a potential for abuse. So they basically nip it in the bud pretty much. So the double loss potential exists because the corporation would hold property with a built-in loss, and the shareholders would also hold stock with a built-in loss. So accordingly, if a corporation's total adjusted basis for all properties transferred by the shareholder exceeds the total fair market value, then the basis to the corporation of the properties must be reduced by this excess. So simply stated, if a shareholder transfers lost properties to a corporation, then the basis of the properties must be reduced to fair market value. So this prevents a double deduction, one at the shareholder level with a high basis and a high basis at the corporate level if there were no reduction. The reduction in basis is allocated in proportion to the built-in losses on a shareholder by shareholder basis. So if the adjusted basis is not reduced to fair market value, then it will have an impact on the holding period. If the total fair market value of assets are greater than the total basis, then there's no reduction required. And if shareholders elect, then the shareholders can take a reduction in the basis instead of the corporation. So they can essentially decide at the shareholder level to elect the reduction versus the corporation. So assumption of transferor's liabilities. Whenever a shareholder transfers property to a controlled corporation, sometimes a corporation will assume the transferor's liability. So let's say they have a property and there's a mortgage on the property, the corporation might decide to assume that liability. So there's some questions, there's some things that need to be considered as to whether the transferee corporation's assumption of the liability is equivalent to cash. Should it be treated as boot? All right. So in certain types of transactions, the transferee's assumption of a transferor's liability is treated as payment of cash to the transferor. So example, if we're dealing with a like-kind exchange, right? That's basically when you transfer one piece of property for a similar piece of property. So it's not really a sale, it's more so like an exchange. So in a case like that, if the transferee assumes a transferor's liability, then the transferor is treated as though he or she received the cash payment equal to the amount of the liability. So they can use this treatment so long as, one, there was a proper business purpose for the debt, and two, the liabilities that were assumed are not greater than the total adjusted basis of the property that has been transferred. In the event that, let's say, the liabilities exceed the basis, in section 357C, which is the general rule, and with section 357C, for purposes of determining gain recognition, the transferee corporation's assumption of liabilities in a property transfer qualifying under section 351 is not considered equivalent to the receipt of money. So there's this, section 357 rather, C. And in such case, then the transferor has zero basis in her or her new company stock, because obviously the basis cannot be negative. It cannot go below zero. So in order to calculate the transferor's basis, anytime there's liability that has been assumed, you start off with the basis in the transferred asset. You would add any cash that was transferred. You would add any gain recognized, which is the excess of the liabilities over the basis. And from there, you would subtract the transferor's liabilities assumed by new corporation. And from there, that determines the transferor's basis in the new corporation's stock. All right, so here we have this example. We're dealing with section 118. So as we look at section 118, this is an example. Stonebriar Inc. wants Robbie's Sporting Goods to locate in its new mall that is developing in Denton. It offers Robbie's attractive land on the mall site upon which the sporting goods store can be built. The fair market value of the land is $1 million. Stonebriar's adjusted basis is $100K. Robbie doesn't have to recognize the 1 million in income. However, it has to recognize a basis of $0 in the land. So this is just a quick example. Next, we have worthless securities. So as it relates to worthless securities, some examples of ordinary loss situations. This applies to securities that are non-capital, stock that's in an affiliated corporation, and there's also Section 1244 stock. So anytime investors purchase stock in or they lend money to a corporation, generally they do that because they want to earn a profit, or at the very least, they want to recover their investment. Unfortunately, some investments, they don't offer an adequate return on capital. An investor may lose part, or sometimes they lose all of their investment. So in this event, the securities that, evidence the investment, they become worthless. So anytime it becomes worthless, there are tax consequences of such stock. So again, we have securities that might become worthless. There might be worthless unsecured debt. If there's non-business debts, that's treated as a short-term capital loss. Or if it's a business debt, it's treated as an ordinary loss. And then ordinary losses are, NOLs, and net operating losses. They can be carried forward indefinitely. However, they are limited to 80% of taxable income. And then as it relates to, tax planning considerations, Section 351, it's not an elective provision. Keep that in mind, right? You don't have to make an election. If the conditions are met, a corporate formation is tax-free, even if the taxpayer does not want it to be. So most often, taxpayers, they do desire the Section 351 treatment, obviously, because it allows them to defer a gain when they transfer appreciated property. But there's some cases where shareholders, they don't want that treatment. They recognize it as disadvantageous, and they actually want to recognize a gain or loss on a property transfer. So in such cases, some individuals, if a shareholder, let's say, transfers to a corporation a property that declined in value, the shareholder, they may want to recognize that loss, so that way they can offset the income. So in such case, the shareholder can recognize the loss only if Section 351 non-recognition rules and the Section 267 related party rules apply. So therefore, they will intentionally avoid meeting all Section 351 requirements, so that way they don't have to defer the gain or the loss. So again, anytime an individual is deciding to form a corporation, you want to make sure that there is proper planning that goes in place to ensure that they understand the potential implications, not just to the shareholder, but also to the newly formed corporation. So this brings us to the end of Chapter 2, Corporate Formations and Capital Structures, from the Pearson's Federal Taxation 2024. Some of the learning objectives we've covered in this PowerPoint was discussing the advantages and disadvantages of alternative business forms, applying the check-the-box regulations to partnerships, corporations, and trusts, recognizing the legal requirements and tax considerations related to forming a corporation, discussing the requirements for deferring gain or loss upon incorporation, explaining the tax implications of alternative capital structures, determining the tax consequences of worthless stock or debt obligations, identifying tax planning opportunities in corporate formations, and lastly, complying with procedural rules for corporate formation.